This is Tom Asprey with the Viper Report. As many of you are aware, I contribute articles on a regular basis to Forbes.com, and I have since the start of this bull market. Prior to my career as a technical analyst, I was a biochemist, and one thing that appealed to me about the financial market was that there was always something new to learn about them. Early in my career, it became very evident that understanding past market behavior was essential to becoming a better market analyst and a predictor of the stock market and the economy. That has been the case. My outlook on the stock market turned sharply positive in early November, and it's been a great run to the upside as we head into April. However, in early April, I saw this technical development, this large red candle here, that's a key reversal formation. There's a couple of articles on the Viper Report about this, and that suggested that the market was going to correct. Those of you who have your own charts, look back on July 27th of 23, you'll see a similar formation. My scenario for the market since then has turned out so far right on schedule. This was a recent article from April 27th. Since the key reversal on April 4th, I was looking for a market correction where, as is often the case when a strong market pulls back, there's a change in sentiment. Therefore, this article I felt that the stock market bears, needed to, see some more pain, and there had to be an increase in the bearish sentiment and moreover a decrease in the bullish sentiment to indicate that the correction was over. One measure of sentiment I talk about frequently in those articles, as well as for my clients, is from the American Association of Individual Investors. And it's not infallible, but nothing is. But this shows you the pattern I was seeing. So this is the bullish percent, which I find the most valuable. 51.7 were bullish March 6th. Okay, so when we get into April 3, when that reversal occurred, it dropped down to 47.3 from 50%. Now, I was looking for a decline in that bullish sentiment because when the bullish sentiment is very high, there's little buying to be done on the sidelines. So that article about the bears needing more pain was written as the sentiment was 38.3, and the following week it dropped to 32.1. This is how the stock market looked at this time. The Spider Trust, it measures or follows the S&P 500. Down here, those of you who've written my articles, I do a lot of analysis with the market internals, something that very few people do, to measure how many stocks are advancing or declining. So when the reversal happened here, we had already seen some breakdown in the AD lines. They'd broken support here. So I was looking for another pullback here before the stocks could find a bottom. See that next Monday we got hit hard again. We started declining down. And then on May 3rd, we gapped higher and closed strong. And look what the AD lines were saying, that they said, okay, that the worst of the decline is likely over. Market data plays a key role in my analysis. I don't look at what somebody else is thinking or what some analyst is saying about a stock price or its earnings. I look at what the data is saying, what the supply and demand is, because over the many decades, I found that's the most accurate way to measure the market. In this article, I looked at a number of charts. You can see this was the weekly chart then. So it come down into its support here, as of the close on the 26th of April. And the AD lines had turned up. That was a very bullish sign. And this plot down here shows you that, as expected, the bullish percentage had dropped sharply. At the lows in late 23, it was down under 25%. Another chart that I introduced that many people are not aware of is the ratio, or the growth stocks, in this case IWF, and value stocks. Well, some of you probably glass over, you look at this, and it is very, very important. Some of you may have been investing in the .com peak in 2000. Okay, we all know about the, .com whatever that went belly up. So it was a peak in growth stocks. They had all these growth stocks not making any money, no sales, no nothing, but they still went up through the roof. So as the growth stocks peaked out here, the value stocks started to outperform. So when this spread is declining, it means value is where you want to be. And you can see that was the case from 2000 up into 2007, just ahead of the financial crisis, when growth stocks started to take over leadership. They bottomed out, value stocks peaked out. And you can see the rest of this years, we know what a great 10, 15 years it's been for not only stocks like Amazon and Apple and Meta and Microsoft, but the general tech sector, which has outperformed everything else. So if you don't know the relationship and who's leading and who's lagging, you can be in the wrong sectors or the wrong stocks, both of which are equally dangerous. That week I also looked at the short-term outlook. So this is a weekly. That other graph was a monthly, longer term. You can see that growth really took off up into February. We got this correction here. So as this line is declining here, that means that value is overall is outperforming. And so that was consistent with some of the technical studies I run. So we're kind of in a critical juncture here, which makes looking at whether you're in growth or value more important. In a recent week, I noted in Forbes that the value ETF was up 4%, and the growth value ETF was only up 1%. So if you were in the right component, in that case value, you had a 3% gain over being in the growth. Of course, that will tell you about other important market developments. Back to the Forbes. If you want to see all my articles, you can just Forbes, Tom Asprey. So just at the end of 2022, I published this article showing about warning signals from the banks. Okay, looking at the technicals, the financial sector here, everything looked like they had topped out. It was a time when one well-known analyst on the financial networks was recommending some of the bank stocks, which obviously didn't turn out too well. Of course, that stock I'm talking about is Silicon Valley Bank. You can see this was right when the article came out here in December, and it went from way up there to bought out here at almost nothing in April of 2023, just 4 short months after the article. The relationship between growth and value helped identify that problem for those stocks. We'd had a nice move, from the end of 21, the ratio is declining, okay, declining. That's good for value, bad for growth. We had a nice bottom here in early 23. Other measures also indicated that tech was going to lead again. And, as we came up right when this was bottoming here, that was when the banks were sending a warning signal. And of course, the failure of the bank in the spring of 23, hit a lot of people, unfortunately, quite hard. But if you're looking at the ratio, the fact that this was rising, it was a weak sign or a negative sign for value markets like the bank stocks. The analysis of growth versus value is used in conjunction with the A&J watch list I've been discussing in past videos. This is a graph from March 15th of this year. You can see the growth was at 100%, value was at 90.9%. Overall, very strong market, up at 80.5%. And you can see that all the inverse, ETFs were negative, all red. All the inverse, that's the leveraged long ones, like TQQ, were all 100% positive. About a month later, April 5th, you can see that market gauge had a lot bullish here, had dropped down to 66.7, and the value had also dropped. And now we were starting to see some green signals, daily DTS flips on the short ETFs and also negative signals on the leveraged long ETFs. That was just as the market was forming that reversal, which suggested that a correction was underway. If you're interested in learning more about these watch lists, there's a series of videos up on YouTube, the Viper Report YouTube channel. You can see that there quite a few of them are here. And if you sign up, you'll get an email every time I put a new video out there. And also, please select notification, because that way you'll be in the first part. But you can, there's a 4 or 5 point series of how they can help you become a better and a more knowledgeable investor and trader. A majority of my Forbes articles go up in the viperreport.com, and the one I just mentioned from early April will be going up later today. Lots of other articles about spotting a key reversal here. Explains how's that defined and why you should look at it. Also, as I mentioned in early March, it was a very bullish environment. We have our current positions up various times, usually once every couple of weeks. So as of March 8th, you can see we're in the SPY total stock market. We closed out part of the XLK position at that point for a 25% profit. Of course, past performance is no guarantee of future results, but these tables showed you pretty much. This is for investors. This original position in the VTI had been held for about 8 or 10 months. And then, of course, also our stock service shows you some of its current positions at that point. If you're interested in subscribing, there are links to the ETF report or the Viper Hot Stocks report. And if you're interested in learning more about the markets, I do recommend lots of things you can read, but I've had a lot of success with teaching students one-on-one. It's surprisingly affordable, probably lower than most psychologists or legal advice, that's for sure. And it's a one-on-one training. If you're interested, you can just email the office at tom@viperreport.com. I'm working on another video to show you why and how the progression took place in the past 6 weeks to turn the utility stocks in the current hot sector. But not a recommendation, frankly, for utility stocks at this point. And in that video, I'll show you why. Thank you very much for tuning in. Please send me your comments, good or bad, and I'll look forward to responding to them. Thank you.